what 99% of us are trained to do. We're trained to bring money into our lives, which represents this green circle here. Over a period of years, obviously, money comes into our life. We're taught to put at least 10% of it away. We put it over here, and we generally put it into things like 401ks, IRAs, that kind of thing. And then most of that money gets put into stock mutual funds. And obviously it gets put into the stock market, and then we ride that wave up and down of the stock market and average rates of return and other things that I talked about during that original presentation. Meanwhile, we're taught to, hey, don't worry, if you need any money to buy anything, any big items, you can always go to your friendly neighborhood bank to buy your cars and your real estate and equipment for your business if you need it, and student loans and all the other stuff that we need to borrow. We can always go to the bank. And the only problem with that is we're taught to put away 10%. Most of us fail dramatically with that. National savings rate's about 2%. You're probably doing a lot better than that, but as a national average, it's 2%. The other national average, though, is 35% of our money goes out in payments to banks. So when you look at that equation, it's not hard to see who's making money. Who's making the money in that transaction. It's the lenders. So really, all we show people what to do, we give them a very simple system that they can reverse the money flow. So now what we show them how to do is take this big dollar sign they have over here. This represents their bank, basically. And the best place to put a bank for an individual is a properly designed whole life insurance policy for a lot of the reasons we're going to talk about. So we reallocate a pool of money. We put that pool of money inside the insurance policy, and now we loan that money to ourselves to do our cars and our houses and anything else we can do, as much resources as we have, that we can self-finance ourselves. And the goal is to self-finance yourself, and then when you're totally self-financed, now the goal is to use your bank like a real bank and finance other people and finance other businesses and real estate and all kinds of things you can do once you've got this finance company up and running. And that's really what you're starting. Most people, once they see this, and I'm sure you're the same way, that's why we're talking here tonight, when you see this, it's simple. I mean, there really is no magic to it. It's just reversing money flow, and yet it's very revolutionary. We've never really been trained that way. And when you start to see how much money you've paid out over your life in payments and compare it to what most people have saved in investments, the numbers aren't even in the same ballpark, right? The bank has gotten much more of our money than we've been able to keep ourselves. So what would happen if we became the bank? And once you realize that, okay, it's very good, it's very positive for us to have our own pool of money that we can treat as a bank and use volume and velocity to build wealth, then it's just a matter of, all right, where are we going to put this pool of money? What account, does what we need it to do and performs optimally to act as a bank? And hands down, 1,000%, it's a properly designed whole life insurance policy. So really, that's all we're talking about doing is redirecting our money flow. And another thing I'll talk about, you might not have seen it in the presentation because I think I've altered it since that recording that you've seen online. But what I talk about when I talk to live classes are wealth stealers. 4 things that over our lifetime and over our business lifetime and working lifetime rob us blind. Number 1 is loss of principal in the market. Would it be real estate market, stock market? And if you've had any kind of money in the stock market over the last 6 or 7 years, you know how quickly you can lose 10, 20, 30, 40, 50% of your money. And when that happens, it takes many, many years to come back. Sometimes it never comes back. Or sometimes you're forced out of the market due to other reasons, due to retirement or due to because you need the money before the funds can bounce back. Second thing that you lose on over lifetime is huge is income taxes. It's the biggest single expense we have as Americans is income taxes over our lifetime. Third thing is lawsuits. People, obviously the more money you have, the bigger of a target that you are. And the fourth thing is payments made to lending institutions. Well, those are the bad news, but the good news is when we treat our properly designed whole life insurance policy properly, there is no risk of loss to the principal because the principal is guaranteed. There is no income tax on the profits inside that policy because that's the way the tax code is. In most states in the country, it's extremely hard for a creditor to be able to get money out of a whole life insurance policy. All right. And the fourth thing we do is once the money's in the policy, show people how to redirect that money flow so they can be the banks and pick up all that lost principal and interest that they're now giving to lending institutions. And at the end of the day, Raul, that's really what we're talking about doing. It's really nothing more complicated than that. I've babbled long enough on this particular section. Is there anything that's jumping off at you, jumping off the page that I can answer for you as far as questions go?
Yes, as far as line number 2, just to clarify, so the income that you make off this, you don't pay taxes, like as long as it goes back to it, as long as it goes back to the policy.
You're absolutely correct. As long as the policy stays open, okay, and you don't close it down, it's not a taxable event to take money out of the policy. You're always going to borrow the money out of the policy, okay? Even later on when you get older and you really want to retire and just live a fantastic lifestyle and live off the money that you've got built up, you're going to borrow money out of the policy. You don't ever have to pay it back if you don't want to, but you're going to borrow the money out of the policy. And you're absolutely right. Growth and dividends, they are tax-free inside that policy.
Okay.
Because really the money's already been taxed. You don't get to take a tax deduction for putting it in there, like you do on a 401k or some kind of a pension plan or something like that. That you get to take a tax deduction, so the money hasn't been taxed yet. And so eventually when those kind of accounts come due and you start taking money out, now you have to pay the tax. Well, really, the money that you put in here, you've already paid the tax on it. It's what's left over. Now it goes in here, and now it's never taxed. Very similar to a Roth IRA, but much more powerful, much more flexible, and the government doesn't have its hands in it. The thing with qualified plans, they call them a qualified plan for a reason. The government qualifies them, and they can change those rules anytime they see fit. There's all kinds of subcommittees going on right now in government that are looking what they can do with this. They think there's about $9 trillion in either private retirement funds or 401ks. So when they see that kind of money, they're looking to see how they can get a piece of it somehow, some way. Well, when we take our money out of that system, we put it with through a private contract with us and an insurance company. It's much harder for the government to go after and change those rules. Not that they can't, not that they couldn't try, but if you were a bureaucrat and there's $10 trillion already sitting in qualified plans that you control, which one, what are you going to try to change if you want more money? You're going to try to change the 401ks and IRAs because it's very easy within your power to do that. Much more difficult to start changing private contracts between individuals and businesses and banks and insurance companies.
Right. Okay. So all the money that comes in here, it's already taxed. It's money taxed. So say for instance, if I want to pull, say 5 or 10 grand out of my company, say on a dividend, and I just want to put it in here, I'm just gonna have to pay tax. It's just gonna be a pass through my personal and pay taxes on that level. But all the money is gonna go in here. Say that's what I want to do, correct?
Correct. Yeah, you will pay tax when it's outside the policy, but once it gets in there, now you get all the growth and dividends and no income tax now for the rest of your life.
Okay, so as far as say if I want to pull money and say for a loan, I want to lend money, maybe like a private loan or whatnot, or a hard money loan to somebody, say at 15%. Is there a specific way as far as how you're going to draw up that contract or that loan, so when that money goes back in there, it's not tax free, or it's all?
There is a very specific way you have to do that, and let's do me a favor. Just shelve that question for now until we actually get into your numbers, and that way I've got some place to draw, and I can actually show you how to set that up.
Okay.
Okay.
All right.
Last thing I want to cover is I just want to cover all the high points of setting up one of these accounts. Number one, we already talked about there's no risk of loss to your principal. Whatever your cash value is day one, and you'll know that today when we go over your numbers, that's how much cash value you have to start with, and it never goes underneath that amount. It's always moving forward from that point. You've got contractually guaranteed growth, so the money is always growing, always moving forward. You got tax-free growth and tax-free dividends. Dividends are not taxable inside the life insurance policy. This is big, especially for a guy your age. Accessible anytime, for any reason, without restriction, on a tax-advantaged basis. So in other words, this isn't like a qualified plan where if you want to pull money out of a 401k or an IRA, you got to jump through a million hoops, fill out a bunch of documents, see if you qualify, and depending on the plan administrator, they can make it very difficult for you to get your own money. And by the way, there's even talk going around right now. They haven't passed anything yet, but they're thinking about it. That right now, if you take money out of a qualified plan early, they charge you a 10% penalty. They're thinking about increasing that to a 30% penalty. Well, you don't have anything like that when you have money in an insurance policy. You're freely accessible. One phone call, one piece of paper that's emailed over to the company. They get you out a check within 48 hours. We already talked about lawsuit proof, judgment proof, and creditor proof. We talked about being able to use this money once it's inside the policy to recapture principal and interest. Easy access to capital the rest of your life. I know, Raul, you're a very successful man. You got a great company going on, and things are good. And my guess is if you need to go to the bank, you can probably go to the bank and borrow money. But as we all know, things change, right? And if something happens where your business takes a hit or your credit takes a hit, and now you need to borrow money. There's an old adage, banks only loan people the money that loan people money that really don't need it. And I think sometimes there's some truth to that, because if you go in the truly need money and you're not in a strong financial position as you were, they don't want to give you any money. Well, when you've got your own pool of funds and you're borrowing it from an insurance company, they don't care what your credit is. They don't care what your job is. They don't care what your net quarterly profit was last quarter. They don't care about any of that stuff. They just want to know how much do you have access to and where do you want us to mail the check. And that's all they need to know. So you've got easy access to capital for the rest of your life. You've got total control of what you're going to use your money for, whether it's going to be personal, business, investment, whatever you want to use the money for, it is your money, and it's accessible anytime at any age without penalty. You've got the ability to put large sums of money into this thing, much more than you can get into qualified plans. And we're going to go over your policy. Obviously, you're trying to put in quite a bit of money, and you can do that with a program like this. It's very difficult to put that kind of money into a qualified plan. Raul, I don't know if we ever discussed this. Do you have children?
Yes, I do.
You do? Okay. How many children do you have?
2, 22, and 20.
Okay, very good. All right, so you got started young.
Yes, I did.
All right. You and I are about the same age, and mine are 8 and 5, so I think you had a head start on me.
Oh, by far.
Okay, well, then another obviously side benefit to this, and this isn't the main reason we're doing it, but it is real dollars and cents that you have to put into the equation, is eventually you are going to pass away. Right? When that happens, you're going to leave a lot more money behind for your family, and that money to them is tax-free as well. At least anything under $5 million is going to be tax-free to them. So not only are you providing great living benefits for yourself and your family, but you're also setting your family up to really produce generational wealth. And I think the key is not just to leave them behind a bunch of money, but it's also to train them what to do with the money. And probably by that time, they'll have their own bank set up, and they'll be doing their own thing. But if you can teach people how to do this and teach children how to do this and leave them behind some money to do it with, you are going to be one day they're going to look back 100 years from now and say, yeah, my great-grandfather Raul started all this. And that's how, a lot of families maintain their wealth generationally is through life insurance policies.
So as far as
you also, this is a big one too. When you borrow money from a life insurance policy, you are in total control of how you want to pay that money back. I'll use an example of a car. If you go buy a car today and you finance it through traditional means through a bank or a finance company, and 6 months from now you get hurt or you get sick or whatever, or your business takes a tank and you can't make the payment, well, within about 3 months they're going to repossess your car. Well, when you borrow that same money out of your life insurance policy from the life insurance company, they don't care if you ever make a payment back. Now, it's in your best interest to make payments back because that's what's going to grow this policy extra fast, and I'm going to go into that when we get into your numbers here in about 2 minutes. We want you to make payments back because when you don't make the payments back, it's almost like stealing from your own bank. And, if you borrowed $50,000 from Chase, they fully expect you to pay them back, and you should fully expect to pay your own bank back. But all that being said, if you go through, a tough time for 3 months, 6 months, 12 months, and you don't want to make a payment, you don't have to. And you'll never get a threatening letter. They're not going to repossess your car. You're never going to get a phone call from them. Worst case scenario, what ends up happening is whatever money you still owe them upon your passing, it comes out of the death benefit. So if the death benefit is $3 million when you pass away, but you owe them $800,000, then your family's going to get $2.2 million tax-free. Okay? So you're in total control of the repayment terms, which makes it nice, gives you all kinds of flexibility to use this money for all kinds of business purposes, and then pay the money back based on the cash flow that venture is generating. So if you've got somebody, if you do a hard money loan, since you brought that up earlier, if you do a hard money loan and you've got it set up where they can pay you quarterly, well, it's nice not to have to make an underlying payment to your bank when you're not getting the money monthly. So you can make quarterly payments, you can make monthly payments every 6 months, whatever you want to do. Another benefit of this is once you're approved for the policy, you've got guaranteed insurability for the rest of your life. So in other words, they can never take this policy away as long as you make the premium. So if you get diagnosed with something 6 months from now, 6 years from now, 16 years from now, as long as those premiums are paid, they cannot take it away. That money is going to be there for your family. You can bank on it. And last but not least, you got the ability very easily, and this is what we specialize in taking that money out of policy and be able to put it into real estate or private loans, hard money lending, that kind of thing. And when you do that and put the money back into the policy, now you're going to have exponential tax-free growth inside that policy. And that's really, one of the benefits that we, by working with people, we show people how to set stuff up like that. And we talked about cash flow real estate in Detroit and the deals our investors are getting are ridiculous. And so really perpetual financing and hard money lending or real estate investing, they're a match made in heaven. And it's also a match made in heaven for small businesses. Because, you know, in the past, if you were going to borrow $100,000 for your company, you would probably traditionally go to the bank. Well, now if you've got the money inside the policy, why not borrow the money out of your policy, self-finance it, so your finance company is going to make money, which in effect you're starting through the insurance policy, and you still get to grow your company, use the same funds you would have from the bank. So there's just so many benefits to this that, you know, it's a long list. And all that being said, what other questions do you have? And then we're going to roll into your numbers.
Well, I guess the questions I had, you pretty much answered them. So.
Okay, good. And that's another reason I go through, you know, that kind of synopsis, because it kind of pulls everything into focus. All right, very good. I have two different scenarios here for you. The one, which I'm going to pull up right now, you have to read this thing first of all. When we're done, I'm going to email this to you. Okay? This one shows you putting in $100,000 a year for the first 3 years. Okay? This is just your age at the end of the first year of the contract, and this column's the number of years in the contract. All right? Well, after the third year, the annual premium to keep it all afloat is $9,400. Okay? In this example, we have the $9,400 coming out of your cash value. So in other words, in this example, Raul, you're never putting in any more fresh money into this program after you put in your initial $300 grand. All right? Well, here's something kind of interesting. You see year 4 says surrender to paid premium. They're going to take $9,400 out of your account. But look what happened to your cash value. Still went up by $11,000. Okay? So again, next year, they pull out another $9,400 to make the premium. Your cash value went up almost $12,000. Okay? And the reason is you have so much growth in dividends already because of the amount of money you're putting in here that it more than pays for the cost of insurance, and this thing still moves forward year after year after year. Okay? So in this particular example, you start off with, when you put the $100,000 in, you start off with a little over $88,000 in cash value. And then what I need to do is kind of draw a line down the middle of this thing. Because really, there's two sides to this illustration. The left side is the guaranteed side. The right side says non-guaranteed, 100% of current dividend scale. All right, all that means is this cash value assumes that they pay out a dividend, the same dividend that they paid out last year, and they pay it out every year. Okay, now here's the deal. Insurance companies do not guarantee dividends, but they do pay them. This particular company's been in business since 1905, and they have never had 1 year in 100-plus years that they did not pay out a dividend. That's through the, you know, the Great Depression, World Wars, you know, different recessions, and whatever you want to call this current economic downturn. They paid out dividends every year. So this side says, okay, if they never pay you out a dividend, this is what your cash value is going to do. Well, I'm not sure about you, Raul, but if a company's been around for 120 years, round numbers, and they've paid out dividends 120 times, I'm pretty sure they're going to continue to pay out dividends most of the time. So I use this side because this has been much more realistic and much more true to company history. Okay? So another thing you want to know is, all right, how much is my starting death benefit? And in this example, $2.4 million. But you can see at the end of the first year, your cash value goes up from $88,200 to almost $90,500, and that's because you're picking up the dividend. They can't pay you that right away because the money hasn't been there long enough. But at the end of the first year, they pay out a dividend. You can see your cash value goes up, and your death benefit goes up. It was $2,443. Now it's $2,452. And the reason is we've structured this with what we call a PUA rider. PUA stands for paid-up additions. And what it says is this. We tell the insurance company, Mr. Insurance Company, when you pay out a dividend, please use our dividends and buy small amounts of permanent life insurance. Now, when I first saw this, I just thought this was some guy trying to sell me more life insurance. And to be fair, he was, and he told me right up front. He goes, yeah, I am. He goes, but it's in your best interest. Do you remember the presentation that you watched online when I talked about, you know, the death benefit and why I'm glad I have a death benefit because I've got children and I need to make sure they're provided for. But I don't get excited about a death benefit. I'm sure you're not excited about any death benefits you have because we know what has to happen for our families to collect on it. So we're glad we have it. We sleep good at night, but now I get excited about a death benefit because now I understand how death benefits work. Your cash value is always chasing your death benefit. And to prove that to you, let me take you down to the end of the contract. And let me point out a couple things to you. If you live to be 121 years old, I'm pulling for you, Earl. I really am. I don't think I'm going to make it with you, but if you can live to be 121, you walk in a very wrinkly old man to the life insurance company, and you can see your cash value is the exact same number as your death benefit. And they will, your contract at that point endows, in other words, it's over with, and they give you a check for $7.4 million. So, in other words, your cash value is always chasing this death benefit. So if the death benefit goes up every year, what has to happen to our cash value? It's got to go up because it's always chasing it. Now, realistically, what's probably going to happen before you hit that age, let's take you to 85. Okay, so in this year, you're 85 years old. You have $2 million of cash value, that's tax-free, and if you die on your 85th birthday, your family's going to get $2.5 million income tax-free. Okay? Now, one of the things I want you to understand, and this is very important to the whole perpetual financing concept, is this illustration you see here, all this cash value basically assumes that you never pull the money out and you don't bank it. You don't bank with it. Well, we know why you're setting this up. You're doing it because you're going to pull a lot of money out, and you're going to use volume and velocity, and you're going to build wealth. These numbers don't recognize that. These numbers just say, okay, if you put the money in and you never touch it, here's what it's going to be. So what I want you to understand is you're going to dramatically affect how quickly these numbers add up. Because if you borrow the money out and you pay it back, the additional money that you pay into the policy also qualifies for growth and dividends. So in other words, after 5 years, instead of having the $317,000 that you're slated for, it's not out of the question. You might have $375,000 in there or $400,000. All right? Because by banking with this cash, you increase its value. And interest on top of interest on top of interest, and it's all tax-free, that means you're going to dramatically affect. So at the end of 10 years, instead of having $393,000, you very easily could have $500,000 in there. All right? Now, one thing I want to point out to you, too, is you're going to notice that that paid-up additions rider makes your death benefit go up every year until the end of year 8. And you can see it goes from 3.1 down to about 1.3 million. And the reason is, are you familiar with what's called a modified endowment contract, Raul? Did I discuss that in the presentation you saw at all?
No, I don't remember. No, I know what it means.
Okay. Modified endowment contract stands for MEC. All right. I'm sorry. MEC stands for modified endowment contract. And here's what basically what MEC means. Many years ago, the government only has been involved with life insurance basically one time. And it used to be, let's say you were going to put $500,000 into this policy. Well, Uncle Sam knows that once the money's in there, he never gets to tax it again. So it used to be that I could put $500,000 in here and only start off with, let's say, a $400,000 death benefit. Well, the government looked at that and said, wait a minute, you're not doing this for the insurance, you're doing this as a tax dodge. And that's exactly what people were doing. So the government stepped in, excuse me, let me grab a little water here. Okay. So the government stepped in and they said, look, you can still put a lot of money inside of a whole life policy, but you have to have a correspondingly high amount of death benefit. So what we did is we took your information based on your age and the money you're talking about putting in the policy. We put it in the life insurance company software, and it told us that you need a $2.4 million death benefit plus some change to not have this become a modified endowment contract. You always want to maintain your life insurance policy as a true life insurance policy, and you never want it to be declared a MEC. Because if it's declared a MEC, there's a 10% penalty, you got to pay tax. It's just nothing we want to do. So we built this policy that it does not MEC out. So once the government has told us, okay, you need $2.4 million worth of insurance, well, here's the way we're going to build this policy. Raul, if I put $2.4 million on this policy to start it off, and it's 100% whole life insurance, the cost of that is very prohibitive. and it'll eat up a lot of your cash value. And we're obviously building this for cash value. So what we do, we basically take about 1/3 of the death benefit, and we make that our whole life portion of the policy. And we also add a 10-year term rider on top. And that gives us our total death benefit of 2.443, but that's basically two policies, one whole life and one term policy. Well, what happens is as years go on, the MEC limit changes. And the software reads that after 8 years, you don't need that term rider on there anymore to conform to the MEC limits. So what happens is that term rider that we set up at the beginning, after year 8, what you see here is it falling off. And what you're left with is basically the $1.3 million of all whole life insurance, and now that continues to grow year after year after year. So what we have to do in the initial years of this is we basically, we have to inflate the death benefit a little bit. And the best way to do that is with very inexpensive term insurance on top of the whole life policy until we don't need it anymore, and then it falls off. So that's what you're seeing there is the term policy falling off, and you'll also see your premiums different. All of a sudden it went from 94 to 64 because now you're not paying for that giant term policy anymore. So now look what happens. Year 9, you're paying your premium $6,400, which they're going to take out of your cash value, and look what happened to your cash value still that year. Now it went up almost $18,000, and you didn't put a nickel in it. Okay, and you're still a very young man, 49 years old. You're still a young man at that point, and you can see to the point of okay, I don't know what time, what your retirement goals are or anything like that, but let's say you want a pretty nice early retirement at 55. Well, $6,400 comes out of the policy. Look what your cash value does that year. Almost goes up $25,000. And all of these numbers assume that you just put the original $300,000 in over the next 3 years, and then you never put any fresh money in it. I've also got the illustration built, and when we're done with this, I'll pull it up. I've got it built that when you see how this grows, my guess is you're going to want to continue to put fresh money in it, and I've got an illustration built for you based on that as well. I'll show you how the numbers are different. What questions do you have for me about this, about your illustration thus far?
As far as this, like say right here on year 1, is it something that I would have to, from month 1 to month 12, I would have to make sure it has 100 grand, or is it something that I would have to put all at once? Like
that's totally up to you. If you want to put it in over time, you can do that. You can put it in over the course of the year, or a lot of people dump it in, up front. But that's only if you have it. If you don't have it, then we can do it. We can do it on a quarterly basis, monthly, however you want to do it.
Okay. All right. And as far as another thing, like, okay, I understand as far as, the guaranteed on the death benefit. Say, for instance, like right now, I think, what did I tell you? I have a term insurance?
Yeah, I don't have the sheet in front of me, but I think you said you got term at about $2 million, I think?
Yeah, term $2 million, yeah. So like again, if say if I die, say when I'm 46, like what would be the payoff for my family? This amount or this amount?
No, right here. That's 46.
Yeah.
0.1 million.
Okay.
Yep.
Even though it's non-guaranteed?
I'm sorry. Go ahead. I'm sorry.
Even though it's non-guaranteed?
Well, I'm just assuming they pay out dividends. Okay, so if you want to go that route, then the guaranteed portion is about $3 million.
Okay, I see.
Remember, this company's never not paid out a dividend, so they're going to continue to pay out dividends. And when they do, that builds up your death benefit even more.
Okay.
And so what you can do now, I got the term falling off of this after 8 years. If you'd like to leave it in place at that time, you certainly can. It's not that it has to fall off, but since we built these for maximum cash value, we show it falling off. But you can certainly leave it on there and let it ride because you've got more than enough money and growth in there to pay for it for sure.
Okay.
Whoops, excuse me. Let me hang this up. Okay.
All right, gotcha.
Any other questions on this part? And I'll pull the other illustration up for you here so you can see what it looks like when you put more money in it.
No, I pretty much get it.
Let me pull up the other one. Okay, so this one we have you same money going in. It's the same 300 grand over the first 3 years, and it's the same premium, but now we have it that you're making the premium. You're making it out of fresh money. Well, you know, you can see obviously you're going to have a lot more money because now you've got more money going into the policy. So, you know, in year 4, when you put in 9,400, here's what happens. There's a paradigm shift that people have once they get this, and I had it. You'll have it. Most of us look at an insurance premium as an expense, right? Well, when you look at it this way, the way we build these things, my insurance premium to me is an asset. Because look what happens in year 4. Well, you put in $9,400, and your cash value goes up $21,000. So if you give me 94 and I give you 21,000 back, how many times you want to play that game?
All day long.
Yeah, so I know you're going to continue to put money in here, and you can put up to $100,000 a year in this thing, by the way. And of course, if you do that, then the numbers get truly massive as far as, you know, how much money you're going to have. But, you know, really neat things start to happen. So now let's go to when your term rider falls off, and then next year you put in $6,400, cash value is almost going up $28,000. So again, put in 64, get back 28. It's not hard to see that this thing's a machine. But it's built the same way, still have the same fall off in year 8, and then it goes up from there. But you're just going to end up with a lot more cash in it because you're putting more cash in it, and you're not taking the $9,000 out to pay the premium and eventually the $6,400 out. You're doing it with fresh money. And, you know, my guess is, you know, obviously your business continues to be successful. You're probably going to put 30, 40, 50 grand a year into this thing minimum. And when you do that, then obviously you're going to have a very early, very wealthy tax-free retirement when you do stuff like that. So especially when you put the money in and you do really neat things with it, like, you know, buy cash flow real estate and hard money loan and all that stuff.
So as far as this, like say for instance, it's all based on what you agreed to start it off with in the beginning. Like
correct. Yeah, with this particular company, your first year dictates how much you can put in later. Okay, so if you do put in $100,000 your first year, that means you can put up to $100,000, actually a little bit more than $100,000 every year thereafter. If you put in 50, then you can put in 50, and, you know, whatever figure you decide to put up.
And you can never extend it, or you
above
just have to.
That you mean? You mean put more in it?
Correct.
No, and in this one you couldn't. But here's what you would do. Let's say it's year 4, and you want to put in $150,000 in it. Okay. Well, we can only probably get about 100 to 110 in this particular policy. We'd open up another policy and put 40 or 50 in that one. So you would have your $100,000 going in this policy, and then an additional 40 or 50,000 going into another policy. And when you do that, it's basically like opening up your branch office of your bank. And at your age and with the resources that you have and what your business is doing, I have no doubt that, you know, you're going to end up with multiple branch offices from this original policy. So don't worry, believe me, you can get in. And also what happens is, Raul, I know you have children. Are you married?
No.
Okay. Okay, so what you could do to get in more money as well in later years, you can take policies out on other people. So you could put the death benefit on your 3 kids, let's say. Well, the death benefit's on them, but you're the owner of the policy, you maintain control over the cash value. So that's another way. If we get somebody that wants to put more money in and we can't put any more money into their one policy, then we open up either another policy on them or we open up policies on other people. So the flexibility of this thing is, you know, unbelievable. You can get hundreds of thousands of dollars a year in this thing, you know, if you choose to.
Yeah, because I mean, I guess the only thing why I'm asking is, like, say for instance, like, because like how the way I see how my business is structured and the way, like, I run my operation as far as like my fleet right now, because I run a total of 75 trucks.
Huh?
And I'm like, next year is gonna be my year where, like, probably like 25 of them I'm gonna be done with, you know, with all those payments.
Yeah. So you're paying them off.
So I know next year is a big year for me as far as, you know, I got to decide, you know, where I'm going to put my money and whatnot. And I know, like, say for instance, right now I could probably say just commit maybe like 50, 75 the first year, but right here, maybe I could just tell you, look, maybe after the 12, 13, 14, 15 months, I could do 150, 150. But I mean, if you're saying I got to structure it, like right now, because again, I don't want to bank on everything, because you know how everything could change and
Sure.
anything could happen. But that's, knock on wood, everything, everything
looks good now.
Yeah, everything's aligned and everything, just going in the right direction. And now that I'm, going into investing in real estate, I see myself making more money. Just because I know how I am.
Well, you know what? Here's what to do, Raul. I mean, here's what I tell people. You start with where you can start with. So if you can do comfortably, whatever, $50,000 or $75,000 the first year, we can write it up as that. And then, okay, let's say you do $75,000. Well, next year you can put up to probably close to $80,000 into the policy. Okay. If you want to put more than that, you're only 40, whatever you're going to be, 41, 42 years old at that point. We open up another policy on you, and you could dump another $100,000 into that one. Or you said you're going to be in Orlando, right?
Yeah.
Do you currently have a pension plan inside your company?
No, I don't.
You know what? What I'm going to show you, it's perfect. We don't show it to everybody because, frankly, not many people are. It's not perfect for a lot of people, but it's ideal for you. The way to put away more money and get a giant tax deduction. We have what we call private pensions, and basically what we do is we show people how to start a pension program, put a bunch of money away inside of the pension program if they choose, and get a huge tax deduction for it. Meanwhile, all the money is put into vehicles that can never go down in value and guaranteed growth, just like this is. So, we'll talk to you a little bit about it in Orlando and show you, in future years, if those things start to happen for you the way you think it's going to, and you've got decisions to make about where to put the money, man, I'll tell you, you put money in a guaranteed pension program along with this, and you're going to be a very wealthy man.
But is that tying up the money where you can't use it?
Well, yeah, if you're going to do a private pension, you're not going to be able to use the money. This, obviously, you can use the money. So maybe that's a road you don't want to go down. Maybe it is. It just kind of depends. If you already had an existing pension plan, then I would certainly show you how we'll blow away anything that you currently have. But if you don't have one, just put it in the back of your head and think, all right, well, look, sometimes it's not all bad. If the money's guaranteed and you know it's going places and you've got other money that you can do things with, sometimes it's not a bad idea to have, some money tied up where you can't get at it because you know it's going to grow. But just, food, you can put it in the back of your cap. If you ever want to do something like that, remember us because we've got a company that's been doing it over 50 years, and they put together some unbelievable guaranteed pension plans.
Okay. All right, yeah, I like this.
Yeah, it's good stuff, isn't it? I mean, when you see what it does, it's like, you keep looking for what's wrong with it. And I spent my first 3 or 4 weeks before I put any money into a policy. I just kept trying to put holes in it because, I was always taught don't ever put money in a whole life policy. But you know what? The fact is they didn't really understand how they built them, and they don't understand how these things can be done. So now I'm such a huge believer in it. I've got several policies on me, on my wife. I'm going to put a couple on my kids, and so it's a great way to go. So would you feel more comfortable at starting off with $75,000?
Yeah, I think 75. I'm good with 75.
Okay. And would that be something you do that up front, or would you do it over the course of a year?
Over the course of the year.
Okay, so if we did it quarterly, or you want to do it monthly, or how would you want to do it?
Let's see, quarterly will be
divided by 4, at about 20 grand. I mean, a little less than 20 grand.
Every 3 months. Yeah, I can do that.
Okay.
And monthly would be.
Monthly is what?
6
grand a month.
6,250.
Yeah, about 6 grand a month.
Yeah, I could do quarterly.
All right, you want to do quarterly? All right, then here's what I'm going to do. Obviously, we're going out of town tomorrow to Orlando. As I know you're going down there as well.
Right.
So when we're down there, come and say hello to me. I get to speak Friday night. For the first time, I actually get to offer a 3-day training where we're going to get together again in Orlando at the end of January. If you could make it, we'd love to have you. And we really take perpetual financing to the whole next level, and we really call it our private money boot camp. We're going to show you how to be the private lender, if that's what you want to do. We're also going to have one of the largest private lenders in the country. They're going to be on site, and I just talked to him today. His name is Chris, and he said, John, we've got more money than we've got deals. So tell your people to bring us deals. We want to fund them, and they're doing some really amazing stuff all over the country. So I actually I'm going to speak Friday night at 7:15, and I'm going to offer that training program. It also comes with a home study program and all that stuff. So, come around for it, and I think you'll probably join us if you can at the end of January, because the investment in the program is minimal, and it's really, for a guy like you that's starting this, you're going to want to know everything that we can teach you. And frankly, right now I've given you Perpetual Financing 101, but there is much more that you could learn to grow this policy and really maximize it.
Yeah, because I guess like my thing, starting in real estate is I know like say for instance they're already throwing deals at me just because some people know that I have a business, or they might think that I have money or whatnot, so they're more serious with me and bringing
Sure.
deals to me. But like my thing is, and again, and I know it's probably the wrong mindset in which I'm trying to use my own money to finance deals, in which I rather but I know the right thing to do is use other people's money. And that's where I'm at right now, where I don't want to tie up my money. But if I know, say I have a private money lender that's always going to be there for me, or whatever deals I bring to them, I don't care tying up my money, because
Yep.
as long as they don't stop me from doing deals.
Yeah, exactly. And then when you think about it this way, it's like to use your money sometimes, depending on what you're going to use it for, is a good thing. I mean, I've got clients now who are using their own money to buy rentals with us. And, they're putting in, let's say, $100,000 to buy 4 properties. That's cash flowing $2,000 a month net. So that's $24,000 cash flow on $100,000. That's 24% cash-on-cash return. I mean, they're not getting that anywhere else. Do they have the opportunity to get that? Not to mention the potential really big back ends when the real estate market turns around. So don't get too. I mean, don't get me wrong. I've done it both ways. I've used other people's money, and when I first started out, I had no, I didn't have 2 nickels to rub together, so I had no choice but to do it that way. But once you get some resources, don't be afraid to leave some money in the deal if it's going to spit off, a lot of income for you. So.
Oh yeah, of course, yeah.
Yeah. We'll look forward to seeing you down in Orlando, and what I'll do is I'm going to tell Greg, who builds my policies, he's going to be down there. I'm going to tell him to redo this one, and we'll show you what 75-year looks like for the next 3 years. And then, obviously you can put in more after that if we need to start another policy or what have you. And we'll break it down and do it quarterly.
Okay.
Okay?
Sounds good.
Sounds good. We'll come on by our booth in Orlando, and we'll look forward to chatting with you.
All right, John. Thank you so much. And once again, I apologize for the inconvenience earlier.
Oh, hey, no worries. I'm glad it all worked out. I understand things happen. I'm glad we got it done before we left on our trip.
Okay. Thank you so much.